All right, so we had another week of earnings. This was the last week of, there's still a handful of companies here and then that'll be releasing, but this is the last week that I'll be talking about. Again, as far as the market goes, S&P, NASDAQ both closed at all-time highs. The S&P touched, I think, 5140, the NASDAQ 16.2 something. Again, both all-time highs. If you look at Bitcoin, again, Bitcoin made a huge run-up over the last week or two. Again, I think it's inevitable, and I think we're just getting started. Bitcoin has never hit an all-time high before the halving, at least in US dollars. Canadian dollars, we did touch around 86,000, which was an all-time high. The previous was, I think, 85 and change. So based on Canadian dollars, we did hit a new all-time high. We're back down a little bit. But again, there was a big sell-off basically the same day because of a Coinbase issue, an outage. People were having issues. We're right back to the low 80s, low to mid 80s Canadian, the low 60s US. I think we probably will hit a new. I think it's very likely we'll hit a new all-time high before the halving, because the halving is about 2 months away, and I think that all news, and not all, but the vast majority of the push is bullish. I mean, you have the ETF scooping up billions of dollars a day. It's inevitable, I think, that we hit a new all-time high by the halving, and then you get a halving with still increasing demand. So I still would project 200,000-300,000, maybe even more by this cycle. I think we still have a lot of room to run because, number one, we have still massive demand. You have just the demand for the ETFs is making up more than the demand for the demand that's even coming online, and that's based on the current cycle, let alone when the halving is priced in, or the halving comes in. So I think that Bitcoin massively bullish going forward still. Again, anything could happen still. As far as the stock market goes, near term, I still think we're bullish, right? Near term, I still think we're bullish. Medium term, again, I still think we're going to see a pullback sometime, I'd say later in the spring or in the summer. How deep it is, nobody knows. Again, it could be 5%, it could be 30, 40%, nobody knows. So that's my outlook for the market. As far as rate cuts go, honestly, there's a distinct possibility that we see 0 rate cuts for the rest of the year. Again, which is crazy considering the market was pricing in 6 cuts going into the year. That clearly was too optimistic. I think it's still pricing in 3, which honestly still might be too optimistic. I still think it's more likely than not that we see at least one, but there definitely is a possibility that we see 0 for the rest of the year, because inflation is looking like it's more sticky than originally expected. So anyway, that's just the market there. First company, a company that I really like, too expensive where it's at right now, but I think is a very good company long term. Domino's. Again, they released very good earnings, but again, if we look at their valuation here, they're actually a little bit below based on PE, less than 1%. They are above based on free cash flow and price to sales. Again, if you got a 5%, for sure a 10% pullback, I would be all over this company. I think it's a very good hold long term, because honestly, it's not even really all that cyclical. Because is people's demand for pizza going to change if you're in a recession? Not really. Maybe a tiny bit, but not really. And again, this is a very good example of a dividend growth stock. They massively increased their dividend here. The previous dividend was $1.21. They moved that to $1.51, right? That's more than a 10%, raising it more than 10%. So, and again, their payout ratio is still below 50%. Again, the yield's only 1.35, but dividend growth will beat traditional dividend investing over the long run. IIPR, they released good earnings. The stock was up probably about 5%, 5 to 10% on that news. Again, I do have a pretty good sized position in this company. If you look at its valuations, it is quote unquote cheap. But I think a price to FFO of 25 is too expensive for this company. I still think, I definitely do not think that it's overvalued where it's at right now, but it's not as cheap as it appears. If we look at its dividend, again, this is one of the main reasons I originally bought it. Again, a 7.4% dividend, the payout ratio is 83%, right? So again, that is definitely a little bit concerning. But again, I was buying this company in the 60s and low 70s. So my yield on cost is around, I think it's over 10% now. So I would probably, if you could get it below 90, I think that's where I would consider it if you don't already have a position. Again, another company here that I have a decent sized position in, Agilent Technologies. Again, they did beat on earnings and revenue. If we look at its current valuation, it is below the PE and the price of free cash flow, although those numbers both are arguably a little bit high, especially PE of 33. Ideally, I think you would get a little bit cheaper, but again, I think this is another example of a solid company that if you hold over the long run, it's going to do good. Again, another example of a dividend growth stock here as well. American Tower, again, do not have a position in this company, but I think it's worth watching because it is one of the largest REITs out there. They did miss earnings, but they beat revenue. Again, I think it's a decent company, although I think that there's just better options, if I'm being quite honest. Although, very nice dividend growth, right? Very, very nice dividend growth. But I mean, over the last decade, it has underperformed the S&P, even with that very nice dividend growth. So that's why I think that there's better options out there. DAR, another company I do not have a position in, but I think I have it on a watch list. So that's why I like talking about it. They did miss earnings. Profit is down, although they did beat revenue. Again, this is a solid company, but I think it's just there's better options out there. GLPI, Gaming and Leisure Properties. Personally, I think Vici Properties is a little bit better. That's why I have a position in Vici Properties, although they did release very good earnings. So again, I think it is worth at least watching. Something that concerns me, though, is they did massively cut their dividend in 2020. This is a company that has underperformed the S&P as well. Just out of curiosity, let's compare it to Vici Properties. So Vici did not cut their dividend, which is one reason why I like it. And Vici also has basically kept pace with the S&P. There's about a 10% difference going back about 7 years. If we go back 5 years, let's just see out of curiosity here. They are, again, also slightly underperforming. I still like it, though. I think that this is an area, again, like casinos and stuff like that. Again, even in a recession, I think people, they're not going to have as much money, but there's a lot of people that they're going to gamble no matter how much they have. Again, it will be a little bit cyclical, but again, over the long run, I still think it's going to do good. I still think it's going to do good. And again, you got a 5.6% dividend, and they're growing that 7% per year. Payout ratio 80%. Again, I still think that they can grow that 5, 6, 7% per year. And again, on a company that already has a 5.6% yield, I think that that's a good deal, right? I think it's a good deal. Based on its historical valuation, let's see where it's at. Again, it is significantly below both of them. Let's compare it back to GLPI here. So GLPI is actually a little bit cheaper, and it's a little bit more below. Again, I still think Vici's a little bit better company, so I think it does deserve to trade at a little bit of a premium. But honestly, I think they're both decent quality companies, and honestly, they're both below historical valuation. So I think that they're both, arguably, you can be picking it up where it's at right now. The next one is Lowe's. They did miss sales and earnings. Although, again, their operating margin was actually up a little bit. So that's good news. Again, these companies, they're going to move with the economy as a whole because, again, when the economy is doing well, People are going to be able to renovate and take on new projects and stuff like that. When it's not doing as well, people aren't going to be able to do it. And it's going to be a little bit rate sensitive as well. So that's Lowe's. Marathon Digital Holdings, again, this is one of the Bitcoin miners. Again, they did beat earnings. Again, these companies had a massive swing this week. They were up massively, then they were down massively. Again, that's just the name of the game when it comes to these companies. Monster Beverage, again, another very, very good company. But again, I do not have a position in it because I've been waiting for a pullback, for lack of a better way of putting it. They released very, very good earnings. So again, the company was up on that news, obviously. Again, if we look at its historical valuation, it's basically right on. I mean, it's a little above the PE. It's a little below the free cash flow. But both of those numbers are too expensive. A price to free cash flow of 43, a PE of 39. I would want that. I think you have to get probably a 15% pullback before I would start to be interested. Probably below 50 for sure. Below 50, that's when I would probably consider it. Probably 45, I think would be more fair, for lack of a better way of putting it. Royal Bank of Canada, they released good earnings. They beat earnings and net income. Again, these are very popular holdings in Canada. They do have American tickers as well. Again, in my opinion, there's better options. Like EQ Bank, I think is a better option. That's why I don't hold these companies, although I think they will do okay as a whole. The next one is TD. The one caveat to Canadian banks is the Canadian real estate market. The Canadian real estate market clearly is more frothy than the U.S. market, so that's something that is definitely concerning as far as the Canadian banks go. Again, TD didn't release as good earnings as Royal Bank of Canada, so again, that's a little concerning if you're a TD holder. VEV, again, they're a healthcare company here. They did release very good earnings and revenue. Again, this is another solid company. I do not have a position in, but I think it's a solid company. They are actually quite a bit below their historical valuations, but those are very, very expensive. Again, it's still very, very expensive. I think you'd need to see a pretty significant pullback to buy this company. And the last one here, speaking of EQB, they did release earnings. They didn't release very good earnings. They did miss earnings, and they were down about 10% roughly because of that. Again, if anything, I'm a buyer here. I think I don't. Again, they did miss earnings, but still, again, this is a company that has a PE of 8. If you compare it to Royal Bank of Canada here, what does Royal Bank trade at? 12, right? So they're a little over 12. Let's look at TD. TD is at 14. And I mean, frankly, I think that EQB is going to grow faster than either of these companies. And on top of that, they trade significantly cheaper than them. So I think fair value for EQB is still probably $100, $110 a share. And you can get it for 85. So if anything, I think EQB is a buy where it's at right now. They're an example of a very good dividend growth company. I think that this is one of the best companies, probably the top 5 to 10 Canadian companies that trade on the TSX right here. Again, the dividend is just below 2%, 1.88, but the payout ratio is only 15%, right? So they're going to keep growing that dividend very, very quickly. And again, they announced another dividend increase, right? They've been growing that number very, 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 very nicely over historically, and they're beating the market as a whole. So I really like EQB. Honestly, anything under $100 a share, I would be buying. But again, you want to make sure you dollar cost average and do not become over invested in any particular company. So anyway, that is earnings from the past week. Again, if you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.